Well, welcome to Chapter 3. Chapter 3 talks about just how corporations are different than personal tax returns. So just very much an intro and how they are set up differently. As they always do with every chapter, and I really like these, is they set us up with a big picture. And so just on the very first page of Chapter 3 in your textbook, you'll see the exact same thing here. Samantha Johnson owns Skylark Bakery. Currently, it's a sole proprietorship. She makes a profit of $100,000. In addition, the bakery earns dividends of $5,000 per year just by investing extra capital. Stock investments. Due to the income from other business ventures investments, she pays a 37% marginal tax rate. So remember, it's a flow through in that setup. And so in her personal return, she's paying the 37% rate. In the past, she's taken $50,000 out of the business, which she believes is a reasonable payment for her services. She's coming to us to say, what should I do? Does it make sense for me to maybe switch over to be a C Corp? And so what would then be the annual savings if she switches over to a C Corp, where, of course, the business form is now taxable? And it says here to look at the 2018 rates. And then we're going to ignore employment tax or state tax. So we're just going to focus purely on the federal tax level for C Corps for Samantha and her bakery. Okay, so that'll be the big picture item that they'll have us walk through throughout the chapter. So the first part of the chapter really goes over similarities and differences between corporate tax and individual tax. And I know a lot of you just completed the individual tax class, so hopefully you'll be able to have a good basis to compare and contrast these. Similarities, gross income is of a corporation, individuals are very similar. The types of things that are taxable revenue are very, very similar between the two. And deductions are also very similar, of course, with a few minor differences. The dissimilarities are right here. Individuals are subject to AMT tax. The corporate AMT tax, though, was repealed with the Tax Cut Jobs Act of 17. In general, all expenses of corporations are business deductions. Okay, so a corporation does not compute AGI. They don't have a standard deduction or itemized deductions like individuals do. And then also the TCJA adds a limitation to the excess of business losses of individuals, which does not apply to corporations. So I know that's kind of small. Let me make this a touch bigger here. And this same chart is on page 2 of your chapter. Just a good handy summary of the two tax formulas, basically getting down to what taxable income is, the tax credits, and the tax due or refund. So both sides of this show kind of just, you can see they're very, very similar in style with a few small differences. Okay, some specific provisions comparing the income tax of individuals and corporations. The following key differences exist. You can see it might be what the accounting period is. Obviously for taxpayers, it's a calendar year. For businesses, it can be different. How capital gains and losses are treated is different. Depreciation, interest expense limitations, passive losses, charitable contributions, executive compensation, net operating losses, and special deductions that are only available to corporations. So those are the key differences right there. They're going to walk us through a little bit about each one. So this kind of starts roughly on page 4 of your chapter. They'll just kind of walk us through each of those specific differences. The first one is accounting periods. It says most C Corps can use a calendar year or fiscal year ending on the last day of a calendar month. S Corps are what they call a PSC, which is a personal services corp. And the text mentions that those are corporations in the fields of healthcare, law, engineering, architecture, accounting, actuarial sciences, performing arts, and consulting. S Corps and PSCs are limited in available year ends. They don't have quite the flexibility that a C Corp does. As a general rule, the cash method of accounting is not available to corporations except for S Corps, corps that are doing farming or timber, qualified PSCs, or corporations with average annual gross receipts of $25 million or less for the most recent 3-year period. Okay, so those are the exceptions. In general, entities that maintain inventory for sale to customers are required to use accrual method of accounting to determine cost of goods sold. There was an exception, though. After 17, the TCJA allows entities with average annual gross receipts of 25 million or less to do the cash method for inventories. It also modified some of the rules regarding the timing of gross income by accrual-based taxpayers. Generally must recognize gross income later in the tax year. Codifies prior law that allows accrual taxpayers to elect deferred income inclusion of advance payments. With related parties, it mentions that if an accrual basis corporation has an accrual outstanding at the end of any taxable year with a related party, it cannot claim a deduction until the related party reports the amount as income. So the income and the deduction have to match for both sides. Okay, so going back to the big picture scenario, assume that Samantha incorporates her business as Skylark Bakery, which she will then call a C Corp, as a calendar year C Corp. She is a cash method taxpayer, owns 100% of the Corp stock at the end of 18. Remember, this is a small business too, revenue-wise. On December 31 of 18, Skylark has accrued a $10,000 bonus to Samantha. She receives the bonus in 19, reports it on her return in 19, but the bakery cannot claim a deduction until 19. So even though she earned it as of 18, because she receives it in 19, she reports it in the 19 return, and that's the same year that the bakery can then claim it as a deduction. Okay, then there's a large section about capital gains and losses. Actually, just about 2 pages, pages 5 and 6, and these are for individuals. You guys probably remember what that is since you just had the class, most of you. Subject to preferential tax treatment because you get the maximum is 20%. Most people will pay 15 to 20% on long-term gains. The short-term gains are just subject to the regular tax rates. Whatever your tax bracket is, the short-term gains fits into that. But your long-term gains are taxed either 15 or 20%, depending on what your income is. And the net capital losses are deductible for $3,000, and the remainder can be carried over as long as you want to. Carryovers do not lose their identity but remain either long-term or short-term. So for corporations, it says here that no special tax rates apply to capital gains. Remember that corporations just pay a 21% rate, so they're going to pay that rate no matter what the size of the capital gain is. And that corporations cannot take a deduction for losses. Remember that individuals can for $3,000, but corporations cannot. So instead, what a corporation can do is offset capital losses can be used to offset gains, I'm trying to say. Unused capital losses are carried back for 3 years and forward for 5. Okay. So the next topic is depreciation recapture, and they mention that on pages 6 and 7. In general, under rules sections 1245 and 1250 are equally applicable to both individual and corporate taxpayers. Corporations may have more depreciation recapture on the disposition, if I can say that word, of 1250 property to individuals. Under 291, a corporation's additional ordinary income equal to 20% of the excess of the depreciation recapture under 1245 over the section 1250. Then there's an interest expense limitation. It says here the taxpayer's business interest income for the year. So the limitation of interest expense is limited to the sum of interest income for the year, 30% of the adjustable taxable income for the year, and the taxpayer's floor planned financing interest for the year. Okay. Amounts disallowed can be carried forward and used in future years. It does not apply to taxpayers with gross receipts for the 25 million or less. Okay, so the deduction for business interest expense. So business interest income is the amount of income includable in gross income for the year relatable to a trade or a business. Adjusted taxable income is taxable income computed without regard to all the items here. So this would be your non-business income gain, business interest, net operating loss, deductions for qualified business income, and so on. Then we talk about passive losses. Individuals and personal service corporations, this is what they apply to, S corps and closely held Cs, so not a publicly owned C. Then charitable contributions, there's a few different rules for those. These are on page 10. Both corporate and non-corporate taxpayers can deduct charitable contributions in the year paid, except for accrual basis corporations allows deduction in year preceding payment if. So what's odd is that a accrual basis corporation, if the board of directors authorizes a donation and is paid on or before the date of the corporation's tax return, it can be deducted in the previous year. So for example, then in 2018, let's just say it's December of 2018, and the board of directors says we are going to authorize this payment in as of December of 18, and we're going to pay it before April 15 of 19. It can be deducted in 18. Okay, that's what they're trying to say. Amount deductible for property and contributions depends on type of property contributed. Also, long-term capital gain property deduction is equal to the fair market value of property. So just a couple more things to think of. Long-term capital gain property deduction is equal to the fair market value of property. So just one more thing to keep in mind. And then ordinary income property deduction is equal to the basis in the property. The corporate charitable contribution deduction, now this is kind of a more important one, is the limitation. It's limited to 10% of taxable income before the charitable contribution deduction, the net operating loss or capital loss carryback, and dividends received deduction. So those all come into play to affect what this will be. Contributions that have excess of 10% can be carried forward for 5 years. Okay, in a carryover year, the current year's contributions count first against the 10% limit. In general, Section 162 limits the deductible amount of publicly held corporations' compensation to any covered employee to $1 million annually. Okay, so this is excessive executive compensation. So this is on page 12, just FYI. And so no matter what we pay an executive, we can only deduct up to $1 million from taxable expenses. So, as expenses deducted from revenues. This is for the principal executive officer, principal financial officer, and the 3 other most highly compensated officers. I give a nice little example of that on page 12. And this is based on all kinds of compensation: straight salary, taxable fringe benefits, bonuses, non-taxable fringe benefits, and so on. So all of those apply. Okay, then we have net operating losses. There's a section on page 13 about those. Those can be carried forward indefinitely to offset taxable income for future years. So NOLs can be carried indefinitely forward. It's limited to 80% of taxable income. Unlike individuals, a corporation does not adjust its tax loss for capital losses, right? Because an individual can take $3,000 off of that. Corporations can't, and make adjustments for any non-business deductions. A corporation is allowed to include the dividends received deduction in computing net operating loss, and they'll show us an example of that. So this is the dividends received deduction. And this is on the bottom of 13, and they also give a pretty good example of that on 14. So your corporation that invest cash by buying stock of other corporations. And then you are going to receive dividends from those other corporations. Okay, and so what we're saying is to avoid triple tax, the dividend received deduction allows the corporation to exclude a portion of those dividends received from taxable income. Because corporations are double taxed, we established that in Chapter 2, but then remember, if you're receiving dividends of another corporation that's double taxed and you receive those dividends, that increases your taxable income and da 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 da. So, but I will tell you with the new tax law, this is lower than it used to be. But remember that they reduced, the corporate tax rates from the mid-30s down to 21. So that's why this was dropped. So the deduction I get is based on what percent of stock do I own of that company. So if I own less than 20% of outstanding shares, it's 50. 20 to 80 is 65. 80 or more is 100%. So the dividends received deduction is limited to the percent of taxable income of a corporation. So I have to compare the deduction to the taxable income that we have already. It says here, for this purpose, taxable income is computed without regard to the NOL, domestic production activities deduction, which we haven't necessarily talked too much about yet, the dividends received deduction, and any capital loss carryback to the current year. The percent of taxable income limitation corresponds to the deduction percent. However, the taxable income limitation does not apply if the corporation is an NOL for the current year. So this is how you do it. And again, this is kind of explained really well on page 14. There's a good chart there. And the next slide is the same chart. The following steps are useful in calculating dividends received. Multiply dividends received deduction received by deduction percent. Multiply taxable income by deduction percent. Subtract 1 from 2. And then subtract 1 from taxable income, I should say. And then we're looking for this. If entity has income before the dividends received deduction, but the DRD creates or increases NOL amount in 1 is the DRD. If DRD does not create or increase NOL, deduction limited to lesser of 1 or 2. So they've given us 3 companies, red, white, and blue. They all have different levels of gross income, but they all have the same amount of expenses and the same amount of dividends received. And that's at the 20% or less range of ownership, which means it's the 50% exclusion. So then we have 3 different levels of taxable income, 260, 180, and 90. And then we do the steps 1, 2, 3. So these steps 1, 2, 3 are these steps 1, 2, 3. Here's my dividends received exclusion, half of 200,000, so it's 100,000 each. Then I multiply that same percent, 50%, times my taxable income. So half of 160 or half of 260 is 130, half of 180 is 90, and so on. Then I take the lesser. So the lesser of these 2 numbers is 100, the lesser of these 2 is 90, the lesser of these. And then this one, though, actually has a different amount. We're going to use 45 for that third one for blue because it results in an NOL. So I have to go back to step 1, and I'm going to use the 100,000 because of the NOL. Because see, that 100,000 is much bigger than 90, so that create a loss. So therefore, I use the 100,000. Okay, there's a little bit about organizational expenditures. Just think about when the company is being organized and being started up. Some of those expenses that you incur, quite often legal, maybe some accounting and things like that. It just says you can elect to amortize these over a 180-month period. There's a special exception that allows corporations to immediately expense the first $5,000. And so what some of those are: legal services, accounting, temporary directors, organizational meetings, fees paid to state of incorporation. So just an example of those. These are on the page 16. And then also an example that Ren Corp incurs $53,000 of organizational costs. Ren can expense $2,000 of that amount. 5,000 minus 53 minus the 50, and the 50 is the exclusion right here, phased out when you have a $50,000 limit, basically. And then that balance is amortized. What's left over, then we amortize over 180. Startup expenditures, basically investigation expenses involved in entering a new business, travel, market surveys, audits, legal fees. Also includes operating expenses such as rent and payroll. At the election of taxpayer, they can be treated the same way as organizational expenditures, up to 5,000 immediately, subject to a cap of 50, and then the phase out over 180 months. Okay, and then we get to the corporate tax formula. So just kind of a reminder of what that was. We kind of had a picture of it earlier on. So my gross income, less deductions, taxable income for charitable limitations, and then we've got that 10% limit. Taxable income for dividends received, less that whatever that deduction is, taxable income before carrybacks, and then net operating loss carryback and short-term capital loss carryback to get down to taxable income. The tax rate, as we talked about in Chapter 2, is now 21%, so that's pretty simple. And then coming back to the big picture example, return to the facts of the big picture back on page 2.1 or slide 2.1. Assume that she incorporates her bakery into a calendar year C Corp, and she takes that salary of $50,000. For 2018, Skylark Bakery has taxable income of $52,500. $100,000 operating profit plus dividends received. $50,000 salary expense is subtracted minus the dividends received exclusion. So taxable income then, or tax liability is $11,025, just simply 21% to $52,500. I'm going to skip the AMT. It's just going away. That's all they're telling us here. And then corporate filing requirements, just kind of some FYIs. You have to file your Form 1120. 1120 is the corporate income tax return on the 15th day of the 4th month, so April 15th. Even if you have no taxable income, you can do an automatic 6-month extension. Payments must make estimated tax payments equal to the lesser of 100% of the corporation's tax for the current year or 100% of tax from the prior year. No estimated tax payments required if tax liabilities expected to be less than $500. Then the chapter itself gives you some really good examples of M1. M1 is for smaller companies. M1 is a reconciliation of basically your GAAP books to your tax books, and so there's just things are reported differently for GAAP than they are for tax, and this is just reconciling the difference. So it's a schedule that you file on Form 1120, and this is for $25 million or less. I'm sorry, $10 million or less corporations in terms of total assets. So 10 million or less. N2 must reconcile retained earnings at the beginning of the year with retained earnings at the end of the year using Form M2. So how do your retained earnings change? Then M3 is for the big guys, so anybody above 10 million of assets. It's basically M1, but just for bigger companies. I'm going to skip the consolidated returns. I'm going to come back to the big picture. Skylark Bakery as a corporation would save Samantha $8,475 in tax if she switches over to the C Corp, which makes sense because her tax rate is significantly lower. And you can see here their taxable income as a sole proprietorship would have been $38,000, much higher than the corporate form. So corporate taxable income is $52,500. The tax is $11,000. The tax on her salary, though, then is $18,500. The $50,000 with the salary, so total tax is $29,525 versus $38,000. So big differences. So computation of corporate taxable income, her operating profit, the dividends, the salary, we subtract the dividends received, deduction of 50%, taxable income is right there. So basically, this just explains that with the high income individual, so we put her up at the highest tax rate for individuals at 37. This made a lot of sense, right? Because the C Corp has that much lower rate. Now, this excludes, as I mentioned earlier, other taxes, employment tax considerations, and tax on dividend distributions. Okay, and did not take into account state and local taxes either. What if the bakery becomes a corporation and generates a $10,000 short-term capital loss? Well, then the regular corporations can only deduct capital losses against gains. So the 10,000 short-term capital loss would be deductible currently by the corporation, would not be deductible. Instead, you carry it forward for up to 5 years. If the bakery is operated as a sole proprietorship, Samantha would report the capital loss on her individual return, and she can use this to offset any capital gains and deduct up to $3,000 of loss against ordinary income. So it's not perfect. If she has short-term capital losses, she would have been better off to be a sole proprietorship, quite possibly. So you have to kind of think through the various tax strategies and what her income looks like.